So it's a calculator we're going to use later, but download that. We're going to make that our best friend, but I'll explain later. So jumping into real estate, this is one of my favorite quotes. Andrew Carnegie says 90% of all millionaires become so through owning real estate. More money has been made in real estate than in all industrial investments combined. The wise young man or wage earner of today invests his money in real estate. So like Rogan said, for the last 2 years, I was an analyst. I was actually the senior analyst for the church's commercial real estate investment arm on their development team. So these are some of the projects that I got to work on. So if you guys have been to Salt Lake, to City Creek recently, you've probably seen this new building. It's called 95 State Street. So that was being built kind of when I came in, but I had the opportunity to do financial modeling on this building and help run some of the post-close analysis. I got to work on a lot of big warehouses in my time there. We did 1 million square footer in Indiana, and these are like big buildings. Like when you think of 1 million square feet, you can fit multiple football fields on top of the roofs of these buildings. But these were distribution facilities. And then we also built a lot of townhomes. This is a community over in Riverton, Utah, if any of you guys have been out there. And they're fully amenitized. This is a public site plan. This one isn't confidential. This one's on Google. This is in Queen Creek, Arizona, but you can see we do a lazy river, we do pickleball courts, we have a place for pets, a clubhouse, a gym, you name it. And so that's kind of what this is our first project we're doing in BTR. It's called Build for Rent. But long story short, I had the opportunity to work on some really big things over the last 2 years and get a lot of great experience. And I love real estate. So, I mean, Garen, I guess a lot of you in Brogan participate quite a bit. And for any of you else who can see my screen, go ahead and chime in. But does anybody recognize where this graph is from or this visual? It's from a book. That's your hint.
Is it Rich Dad, Poor Dad?
Yeah, nice job, Cordell. Yep, so this is Rich Dad, Poor Dad. So this was one of the first books I ever read about real estate that kind of hooked me on real estate. And this is one of the things that he hounds on the whole book is basically on the left, you have what the middle class do. So they make their money and then they acquire liabilities, credit card debt. They go buy a car. They put it into school loans, and some of these things can be good things. But the moral of the story is most American consumers acquire liabilities before assets. And so the premise of the book is first, keeping your expenses as low as possible, your liabilities as low as possible, and first acquiring assets. And then those become their own balance sheets. And then those can start generating income, basically to help you get out of this cycle. So I read that book. I loved it. And then I also found this book by Grant Cardone, How to Create Wealth Investing in Real Estate. And to be honest, I hate Grant Cardone. I don't like him. I think he's kind of a schmuck, and I would never invest with him. But I'm really grateful for him because I read this book, and that's what got me into commercial real estate. But anyways, so sorry guys, PowerPoint's frozen here. So yeah, I want to go over kind of obviously the reasons of why to invest in real estate. So the first one obviously is mortgage pay down. So when you acquire real estate, you have tenants who are literally paying your payments to the lender. So in 30 years, you could pay nothing and literally own an asset that you didn't pay a penny for. And then another reason is cash flow, obviously. The goal is to run a property well enough that not only are your tenants paying for the debt service, but you have a little left over that you're also making money that you can then go to buy more properties. Another is appreciation. So this is a house I found. I literally just pulled it up on Zillow. This one is in Farmington, Utah. So you can see it's nothing special, just a little small, modest starter home. This was the value of it in 2019. So you could have bought this house for $270, and I just looked. It's on the market right now for $510. So appreciation obviously is another powerful reason to invest in real estate. I always kick myself for not buying sooner. My brother Jason lives in Traverse Mountain, and when you calculate how much appreciation he's made annually for the time he's lived in his house, it's about $80,000 every year. So it's kind of like a salary on the side. of what he's been doing just for living in it and using it. So obviously real estate isn't going to appreciate like this every year, but appreciation like this can happen and does happen. Another reason to invest in real estate is it's an inflation hedge. So what I mean by inflation hedge is when everything else gets more expensive around us, if you're a landlord and you have tenants every year, when those tenants re-sign, you can sign them at higher rents, correct? So you can see here on this graph in February 2019, the average rent, well, the median asking rent in America was just over 1,600. And you can see how that's climbed today to almost 2,000. And that's just going to keep going up. So if you own real estate, you're hedging against inflation because as prices increase, you can pass on those costs to your tenants. Another one is reduced volatility. So maybe some of you have had this experience. This is my Robinhood. Have any of you guys traded stocks? Yep.
Yeah, absolutely.
Oh yeah.
And that Dogecoin.
Doge. Yep. So the Dogecoin was about here, right up to here. That's the euphoria, right? I was making tons of money. And then, you know, stocks and crypto are obviously super volatile. And I started being really stupid with my money. And this is what my portfolio looks like today. So I'm slowly crawling my way out of this hole. But the moral of the story is real estate isn't as volatile as stocks and crypto and all these other alternative investments that you can make. And hopefully you guys can see this. These are some of my historical trades between May 5th to May 13th. So this is an 8-day period. And this is just one stock, one crypto. This is Ethereum. So you can see how much I was selling and buying this. And every time I was doing it, I had emotion involved in my decisions. You know, Robinhood's taking fees on every single one of these. Every time I'm putting in a bid ask to buy this, it's triggering a little higher than what I actually think I'm getting it for. And this is just super unhealthy. So you guys have probably realized this or done this, but like the way to make wealth is not staying up all night long, buying and selling a stock over and over again and trying to time it perfectly. So I recommend not doing this. And I kind of totally switched my investment thesis to real estate. It's more of a slow, less volatile way to create wealth. And this graph kind of illustrates that. So this is the U.S. housing price index since 1900. So you can see from 1900 to 1950, it was relatively flat, but since then it's been on a tear. And a lot of people, like, they let the fear of kind of the fact that home prices are so high today keep them from investing, you know, because they have that fear of what if I buy and then the housing market crashes. But if you look at the last 120-year history, there's been one big real estate crash in real estate. So if you might live 80 years. If you're buying real estate every single year, those are pretty good odds that, yeah, you might live through one or two real estate recessions, but for the most part, it's not volatile and it goes up over time. Another powerful reason to invest in real estate is leverage. So this is that same snapshot of my Robinhood. You can see right here, this is the cash in my portfolio. And if I went out and bought on margin, they would give me up to $40,000 in trades. Now, if I had the same amount and I put it into real estate, I could buy $500,000 worth of real estate because you can lever real estate so much higher than you can a stock or crypto, right? So for residential, like if you get a VA loan or you served in the military, you can get up to literally 100% loan to value, which means you could buy a house for $0 down. There's FHA programs, first time home buyer programs, as low as 5% down. Even for an investment, you can get 80% of the money from somebody else to fund your real estate, which is just awesome. Tax advantages is another huge one. I'm sure you guys have heard of these, but 1031 exchange. Does anybody know what a 1031 exchange is and can explain it?
Isn't it basically when you roll over what you made from a property, like you sell a property and you roll it over into another property, and then you don't have to pay capital gains tax, right?
Yes, exactly. Yeah. So you have to find a property that's a similar value and similar size, and you can roll it over totally tax-free into that next project. Then you have to wait a few years, and there's obviously regulations, but it's a way of, just like this visual shows, of building up a real estate portfolio totally tax-free.
Mitch,
and
do
then
if somebody buys a new residence, like a new house, like a primary residence, and they had a previous primary residence equity, what is that considered? So after 2 years, they don't have to pay capital gains on it, but it's not considered a 1031, right?
Yeah, there's little quirks with what you can and can't do as far as if you're occupying. To be honest, I'm not a 1031 expert, so I'm not sure if this applies only to investment properties or if it also applies to private residences. I want to say it doesn't work on personal residences. Maybe it does. But yeah, I'm not 100% sure how to answer that, Brogan. But the reason I highlighted, so does anybody know what PITI means? Pity. Have you guys ever seen that abbreviation? So whenever you see this abbreviation, it's principal, interest, taxes, insurance. Those are kind of like your big four expenses when you're investing in real estate. And the reason I highlighted the ITI is because the interest, taxes, and insurance expenses that you have in real estate are all tax deductible. So you can write all those off as expenses. The only one you can is the principal payment, because that's equity that you're actually creating. And then, all the admin, travel, anything else you do to help your real estate portfolio, obviously all tax deductible. You guys know this. Some other big ones is like cost segregation. Has anybody ever heard of a cost segregation study or what that is?
Yep.
Anybody besides Brogan? So a cost seg is, Isaac, I saw you turned off your screen. Do you want to take a stab at it?
Dude, I honestly have no idea. I've heard it before, but yeah, I don't know.
Okay. So yeah, Trump passed a law when he came into office that allowed essentially you to buy an investment property, and typically for tax purposes, you can depreciate a residential asset over 27 years. Commercial is higher. I think they're like 39 or something like that. But typically you have to straight line depreciate an asset over 27 years. But this law that Trump brought in, he said, okay, via a cost seg study, you can do 100% depreciation of your asset year one. So as soon as you buy it. So a cost seg is, they come in and, it's a full blown out study on, the rugs, the cabinets, the blinds, everything in the house. And, they've got their method of how to do it. But essentially you're creating this big tax liability to then offset your income with. And you can go use that to offset your passive income. And if you have real estate professional status, you can even use it to offset active income. So if you already have a lot of tax liability from passive income, then cost segregation is another incredible way to save money with real estate. And then obviously there's long-term capital gains. Once you get into commercial real estate, there's opportunity zones. So there's zones where you can go develop real estate and you'll get tax credits if you hold it for long enough. There's a low income housing tax credit. If you have a certain percentage of, say you build an apartment building and you designate a certain percentage of it as affordable and they're below certain median area incomes, then the government will literally give you tax credits. So there's so many tax advantages in real estate. Another one that I love is it provides value and utility. So if there's ever a bad recession, like people would still need a place to sleep, right? So that's what I love about multifamily, especially. And like you could buy an Airbnb and you could use it for 2 months of the year and rent it out for the rest of the year. So real estate provides value, which is what I love. It comes with rights. So I put this picture on because it reminded me of Burley, Idaho. It's where a lot of us are from. But real estate often comes with water rights, mineral rights, air rights. Another one is land, first of all, is finite. There's a fixed amount of land on earth, and a lot of it has already been claimed. You know what I mean? And you can't make any more land than there already is. And then real estate, obviously you can build more of it, but it's a constrained supply. You can't snap your fingers and build 100,000 new homes in America. There's a reason why there's a 2 million, well, approximately a 2 million home glut of homes in America. And it's because the developers can't keep up. They can't build enough for how many people want to buy a home. And that's the beauty of it. Like crypto or a stock, a company can issue more stock. They can dilute your shares. They can always make more cryptos. But real estate's awesome because the supply is constrained. That makes it harder to get into, but you've got to start somewhere, right? So this is Utah County. This is Utah Lake right here. So in 1984, just look at like all this farmland. This is Silicon Slopes. All this is just dotted with offices now. There's homes clear out here in Eagle Mountain. Fast forward to 2020, and you can see the difference. There's just development everywhere. And this is called urban sprawl. So Utah is supposed to add 2 million people by 2060 based on its current growth rate. So by 2032, it'll top 4 million. By 2050, 5 million. And then by 2060, it'll be close to 6 million people. Another perk of real estate is private banking. That's what I call it. That might not be an official term, but the way I think about it is once you've built equity in your real estate, you can then pull that equity out and use it to invest in other projects, right? So has anybody ever heard of a HELOC or know what that means? Garen, you've got it. Home equity line of credit. So, say you have $100,000 of equity in your $500,000 home, you can literally pull that out and go use it to invest in other projects. And then real estate obviously can be used as collateral. So if you need lending on a project, you can collateralize your existing real estate to go get loans for more. The growing renter pool, cost of home ownership is obviously outpacing wage increases. So homes get more and more expensive every year. Honestly, I'm pretty worried about my kids and especially my grandkids. I don't know if they will ever own a home. I'm hopeful, but the way it's looking, like they might not. So you kind of just have to decide what side of the coin you want to be on. Do you want to be on the owner side of that, or do you want to be on the consumer side of that? I want to be on the owner side of that.
Mitch,
and then control.
What do you with your last slide? What would you expect, like the number of a renter I guess need would be for Utah and Idaho? I know there's a housing shortage of 30,000 homes or something. Is there a similar number to that for renter need?
Yeah, it's out there. I don't know what it is off the top of my head. I think I saw in an article this week that the US has like 45 million renter households. And obviously, expenses go like this, but wages only go like this. So that number is just going to keep going up and up. You know what I mean? The data is out there. I don't know what it is off the top of my head, but the answer is yes. Control. That's the next one. So stock, you can't control whether it goes up and down. Honestly, it's really up to Wall Street. They control how money moves in society, and or the press. The media can come out with some negative news on something. I saw a stock go down yesterday by 30%, and it was simply because their CEO, gave 3% less expectations than the Wall Street analysts had. So real estate's awesome because you can manage it and you can control the outcome. You can find a better property manager. You can cut expenses. You can increase rents. You can buy in better locations. There's so much you can do. You can, just like a business, there's more control, and then you can add value. So you can increase value through upgrades, better management. And you hear of fix and flippers. They'll go out and they'll put in 20 grand into a home, and then they'll flip it on the market for 80 grand, and they'll take a 60 grand margin. And then once you get into like multifamily and doing bigger projects, the profit margins are pretty high. So like net operating income for multifamily, for example, is often 50 to 75% of gross revenues, which is amazing. You think of like owning a grocery store or like a retail store, and your margin might be like 10%. You have to do a lot of volume to keep up. So now I wanted to show you guys kind of how I analyze deals. So this is more tailored towards like you're buying a single family rental or a duplex, triplex, or fourplex. This is kind of what I use to analyze the smaller stuff. So I'm going to close out of the PowerPoint. Do you guys see Jesus right now? That's my screensaver. I'm trying to see what you guys are seeing. I might have to reshare.
We
But now-
we see the PowerPoint.
You see the PowerPoint still? Okay,
Yeah.
I'm going to stop sharing. So now, Isaac, you might have missed this. Carter, you might have missed this. But download Mortgage News Daily if you guys don't have it. So it looks like, show you what it looks like. Just go to your app store. Looks like this.
I'll share it with him too.
This is what I always use to analyze like my fourplex deals. And I'll do it on the desktop version as well. The app is so much better though. It's just way better. So I recommend doing this with me, but I'll teach you guys how I analyze a deal. Let me just share this. Can you guys see my screen now?
Yeah.
Yeah, we can see like a Google website.
Perfect.
Yeah.
Mortgage News Daily now. Can you see this?
Yeah.
Perfect. So yeah, so this is how I analyze deals. Go into Mortgage News Daily, and right away it'll show you like the average rates, the interest rates for the market. So just to explain what all these are, the first one, that's kind of your most typical mortgage rate. It's your 30-year fixed. So you can see right as of today, it's at a 7.16. You can get a 15-year fixed rate, which means you're paying off your home in half the time. Your payments are going to be way higher, but obviously you get rewarded, so the interest rate's a little lower. There's these jumbo loans. This is for loans that are outside of non-conforming limits. Those typically have higher interest rates. There's adjustable rate mortgages. So this one's a 5x1. That typically means that for 5 years it'll be floating, or it'll be some fixed rate, and then it will go adjustable. And then FHA, that's a first-time home buyer loan. And here's this might interest you, Brogan. For example, you already own a home, but if you bought another home that was a little bit bigger than your current one, you can actually do another FHA loan. So it's kind of ironic, even though it's called a first-time home buyer loan. You can see that's like, obviously there's some other nuances, but yeah, there's ways to use it more than once. And then this one that says VA, that's for veterans. But anyways, so I typically just do my analysis based on the 30-year. So I see that that's a 7.16. Maybe for this one, let's assume that we're going to buy a fourplex and you guys are young, you're going to go live in one of them. So that would mean you qualify for a first-time home buyer program. Anything above 4 units is commercial, so you guys wouldn't be able to use an FHA loan, but up to 4 units you can. So we're going to use this. We're going to use 6.7%. And so in your app, there's a little calculator. It's in the top right corner. On this one, it's right here. It just says, see where it says payment with amortization. We're going to click in here. And then it pulls up this calculator for us. So we're just going to like make a theoretical scenario and try to figure out, if a deal pencils, let's say we find a fourplex for 150 grand and Isaac, you're going to go live in it. So you're going to qualify for an FHA loan, which means you can put as low as 5% down. We're going to put 5 right here. So that's 42 grand to get into your fourplex. So you're 807 grand from the bank. And then we said we're going to use an FHA loan, so 6.7%. We're going to do a 30-year amortization schedule. So you notice that this actually goes higher. Obviously, this is totally based on what you guys get approved for with your lenders. But it's becoming more and more common to even get a 40-year amortization schedule, which just means you have 40 years to pay back your loan instead of 30, which decreases your monthly payments. So that can be really powerful if you can achieve this, but 30 is pretty standard. Let's say you're going to buy this in March. And let's say it's not in an HOA. So we're just going to put our HOA at 0. And then for taxes and insurance is tricky. For taxes, typically you just go to the county for the deal you're you're analyzing, and they'll have a tax calculator for you. You can put in the address, or you can put in the value, and they'll tell you the approximate taxes. The number I use just as kind of a gut number is I just take the value and I multiply it by 0.00375, which I dropped in the chat. So if you do 0.00375 times 850 grand, so monthly taxes comes out to 3188. And then for insurance, I multiply the value of the asset by 0.0025. And these aren't necessarily right. This is just what I do to kind of get a gut idea. It might be high, it might be low. And this is just to really do it fast to see if it even works at all. So now we're going to do 850 times 0.0025. So, okay, we'll call it 2125 is your insurance. And then it calculates everything for you. So you can see your total payment every month is right here, 56.53. And it shows you what you actually pay on this fourplex over the course of 30 years. You're really paying $1.9 million almost. I used to let this number scare me and be like, those dang banks, they're charging me 2 houses. But really, I don't care about this number, because over the course of 30 years, really inflation is chipping away at that number, right? All I care about is this monthly value, because that's going to be fixed forever unless you do an adjustable rate mortgage. This stays the same. So as long as your renters can pay that, you're good. So then I just do 56.53 divided by 4. It's fourplex. You guys know you need $1,400 per unit. And if you're going to live in one, then you just know that that's what you're going to need to pay, so that everybody else pays their $1,400 and you're covering the full debt service. Really, you also want to think about maintenance and property management as well. If you're living in a unit, then you can manage it yourself. But if you're just buying an investment property, you probably want to hire a property manager, and they may take anywhere between 5 to 10% of your gross rents. So you want to think about buffering that into this calculation, and then also, buffering in some maintenance costs every month. Maybe you're putting $100, $200 to the side. But that's really how to analyze deals. So just to illustrate how things might change, if you go from a 30-year AM to a 40-year AM schedule, that saves $400 a month. If we put this back to 30, if you guys bought a fourplex in 2020, 2021, when the Fed dropped interest rates all the way to bottom, you probably could have got a 3.5% interest rate. So watch what happens to your payment on this. $4,000. All you needed was $1,000 per unit. And if you bought that at that point, you had this rate today, and now fourplexes are getting $1,400-1,500 a unit in Utah. Now you're cash flowing almost $2,000 every month. You know what I mean? Any questions there before I keep talking? Sorry, I've been talking a lot.
Hey, Mitch, on your home insurance that you put on there, is that what the 2.5% was?
Yeah. The value, the price of the asset times the 0.0025, which is actually less. It's a quarter of a percent, right? Times the value.
Okay, gotcha.
Yeah, that's how I came up with that. And then the taxes, I used the 0.00375. Those are the two numbers I found that just get me to the quickest, fastest answer. And then if it looks like it's a good investment, then I'll actually go dig for more true numbers, because sometimes this can be high, sometimes it can be low. Any other questions on this?
So Mitch, what do you put in for vacancy? Do you calculate vacancy in there?
Yeah, no, you totally should. And I mean, the way I think about residential, so anything between 1 and 4 units, and the way I think about commercial is totally different. But kind of like I said, add in a buffer for your property management fee, for your maintenance. Vacancy is another one you can definitely slap on, 5 to 10%, just to give yourself even more conservative numbers. So that's a great point, Isaac.
Mitch, when you're looking at like the home price, because obviously you can adjust the home price right there. Let's say it's listed at 850. How do you know that like, that's comparable? What are some analysis that you do to do some, comparisons? Is it recently sold? Where do you go to find those recently sold? And obviously if it's for sale, you would be able to find it if it's at least on Realtor or, website, Zillow, right?
Yeah. So I mean, Zillow is a huge one. Obviously, you can go see everything that's been recently sold on Zillow, right? So that's a good way of seeing comps. And then I'm licensed in the state of Utah, so I have a real estate agent license. So I get I get access to the MLS, so I can see all that as well, and like all the more nitty gritty details of everything. Because you can only see so much on Zillow, right? But Zillow is a great place to start. You can go find recent sales comps in the neighborhood and just make sure you're not getting gouged. What other questions do you guys have on this topic?
How before you buy a property, how competitive are you trying to find like a better interest rate, right? Or is that almost near impossible? Or like who do you talk to make sure that you're buying the correct or getting the correct loan?
Yeah, like getting the best interest rate possible.
Yeah, and the correct loan for the property, right? Do you just talk to an experienced mortgage lender or what?
Yep. Yeah, really just I like to shop lenders, so just go get approved. That's the first thing to do. And typically it's a hard credit check, but I mean, one credit check every once in a while isn't going to hurt you unless you have like a really big purchase coming up. But if you're buying a house, you have to do that anyway. But then you can go price shop with different lenders and you can try to get the most competitive rate. And you really, like you saw those rates on Mortgage News Daily, like those obviously aren't guaranteed. If your credit score is 600, like you might be below that. Those are just the average rates. If your credit score is like 750 or 800, your rate might be lower than those. So really it comes down to, you just need to go get a pre-approval. You need to find a lender. They'll send you a folder and you'll fill out a financial statement. It'll talk about the assets you have. They'll do a credit check on you, and then they'll tell you what rate you can actually get. And then typically you want to go price shop, with a couple different lenders and see who can give you the most competitive terms. But on that topic as well, rates right now are obviously really high. So like 2 weeks ago, I got on the MLS. I analyzed 66 fourplexes. I did what I just did with you guys, literally looked at 60 of them. And I think like 2 of them broke even. So at current interest rates, it's really hard to make stuff pencil, but there's more ways to do it than just going to the market. So have you guys heard of seller financing?
Yeah, I have. I don't know if everybody else has, but
So seller finance, like you guys could go knock doors of fourplexes in the area. I mean, honestly, that probably doesn't do any good because you're gonna run into tenants. The better way to do it is to get on the county assessor, and they'll show like who owns certain parcels. Like go find your county parcel map. Sometimes it's an LLC, but sometimes it'll have the name of a person, and then you can like track them down and find their number. I do this all the time. And then call them and be like, hey, have you ever thought about selling your fourplex? And if they say, yeah, I'm actually interested in selling. Okay, cool. Have you ever considered seller financing? So seller financing is when instead of going to a lender or a bank to get your loan, the seller of the asset is basically becoming the bank, and they're carrying the financing for you. So you're paying them a down payment. They're carrying the rest of the loan, and then you're paying them interest instead of the lender or the bank. So they just become the bank. And seller finance is awesome because in the market today, interest rates are so high that shrinks the buyer pool because nobody can afford stuff. And so all these homes start sitting on the market longer, and these sellers become more motivated to sell. And so they're willing to do more creative things. And a lot of them will give a below market interest rate. So I have friends who are getting like 3-4% interest rates right now on seller finance deals, when like the best you could get at a bank is like a 7 for investment. And that makes your deals way more likely to cash flow, right? So seller finance is awesome. Another one, like if you want a primary residence, home builders is another great way to get low rates. Like new home builders, they have to just keep building homes and keep selling those homes so they can build more. So, you know, think of these big companies. So typically they do rate buy downs and they'll often pay for closing costs. So like, for example, the market's at a 7 right now, but I know of some home builders down in Utah County where I can go get a 5.5% interest rate right now, or even as low as a 4.9% adjustable, which is awesome. So like, there's lots of different ways to get better interest rates. Shop lenders, you could do seller financing. You can buy from a home builder. And obviously the best way is to, you know, make sure you guys' credit is staying really high. You're making good money so you guys can qualify. But yeah, that's how I'd answer that, Rogan.
Appreciate it.
So before I just kind of like turn it over to any general Q&A, I'll share with you guys kind of what I'm currently working on. So as Brogan said, I started my own real estate private equity company called Elkstone Capital. Let me see if I can share my screen here. You guys see this?
Yeah, it's pulling up.
Cool. So going back to the Grant Cardone thing, like I said, I don't like Grant Cardone, but his book was about like why invest in one door when you could go buy like 50 at a time. That was kind of his pitch. And really it was his pitch to get people to invest money into him, right? But you know, that rung true with me, and it made sense for me to pursue that strategy because that was kind of like what I studied, and it was kind of the technical skill that I made sure I had. So my last month of sales was in May of 2021. That was my last full month. I did a few weeks the following year, but I made about 55 grand in that month. And then I actually went and worked for free. I think that's why I did so well, because I knew I was going to work for free for the rest of the summer. I got an unpaid internship to go learn commercial real estate and how to like analyze deals, get really good at Excel, get good at financial modeling. So I worked for free for the rest of the summer, but it was a great springboard for the rest of my career so far. And it made sense for me to go the commercial route because that was already my background and I already had those skills. If you don't have those skills and you're good at making money in some other way, maybe the best way for you is to build up a private portfolio of duplexes, triplexes, fourplexes, single family rentals. That might be a great way. But I wanted to go a little bit bigger. So to show you some of the things that I'm working on, so this is the Easton Apartments. I helped to raise $7.5 million for this deal. This is in Nashville, so 206 unit apartment complex. And yeah, I basically for 2 months I dialed and I cold contacted investors and tried to get people to invest in this deal. And ultimately we were able to get all the equity we needed and we closed on this. So this one's in Tennessee and I'm a part owner in this one. This is with a partner of mine named Alex Mashburn, with a separate fund that we're starting called Mountain Equity Group. This is an apartment complex in Murray, Kentucky. It's 32 units. So if you guys have heard of John Morant, he went to Murray State. So this is right by Murray State. That's another apartment we're doing. So it's pretty old and run down. So we'll go in and we'll repaint everything. We'll put in new vinyl flooring. We're going to bring everything up to code. There's a lot of issues with it. We're going to paint the exteriors, add new signage, re-landscape the whole place, fix plumbing issues, fix electrical. But we're getting this for like 60 grand a door, which is pretty amazing. And the rents, so the owner who owns this now actually built this back in 1967, and he's owned it forever. And this is like the first thing he's finally selling in his portfolio because he's 87 and I think he knows he's not going to be around for long, but he also hasn't raised rents. So the average rent here is $348 per unit for a 2-bed, 1-bath. And the market for a 2-bed, 1-bath is about $1,000. So based on, we've looked at comps, what other things are renting at in the city. And we think if we, put a couple grand into every door and make this nice, we can pretty much 3x, maybe 4x the rents. And that's just going to create an absurd amount of value in this deal. This is another one.
I've got a question. When you do like a value add on these apartments, are you getting loans that are far greater than the value of it, and then just using the loan to do the value add capital, or do you have to bring in your own capital for the value add?
Yeah. So with commercial real estate, typically, so if you hear the term capital stack, that's the dollars you need to fund the deal and to put it under contract. And most of that capital stack is going to be debt. So traditionally, you're going to go to a bank or credit union. If they won't lend on it, then you're going to go to a debt fund that will, or like your last case is like a hard money lender. And typically the loan, so the debt on the project will be anywhere from 50 to 70, sometimes as high as 80%, but that other 20 to 30%, you're going to have to raise in equity from private investors. The bank wants you to go out and get investors to put together some equity so that I guess us as the general partner, we also have skin in the game, if that makes sense. So yeah, typically it's 60, 70% debt and the rest is equity. And then, yeah, you have to go out to investors and raise the funds to be able to fund those projects. Does that answer the question, Brogan?
Yeah. So, I mean, it sounds like you could have two different loans on a property. Does that sound right? Potentially.
Oh, yeah. So that was your question. So the scenario I just explained was one loan, but yeah, sometimes you can have two loans. Like maybe your credit union that you're sourcing your debt from only lends up to 60%. You only have 20% equity and you can't get any more. So you're missing 20% in between. So that's what's called, the term for it is called mezzanine debt. So basically it's a piggyback loan. You go out and you get a second loan. And yeah, that loan is going to be in second place. So like if anything happened, the first loan obviously can take the property as collateral. And so they're more protected. And because of that's the second loan is going to have a way higher interest rate, and they're going to have more points up front that you're going to have to pay them as a portion of what they're lending you to basically cover their risk. So yeah, you can have two loans on one property. Do you guys have any other questions about this deal? The last one, so this is the current one I'm raising for. So if you guys have any rich friends, send them my way. This is another deal in Nashville that I'm raising for. So total uses is a $34 million deal. So this property, it's called the Flats. It actually has a Fannie Mae loan, which is a government loan on it. And that loan is at 4.88% interest. And we actually get to assume that loan from the seller. So we get to come in day one, instead of like originating new debt at 7%, which is where it would be today if we got a new loan, we're picking it up at 4.88%. And there's even what's called interest only. So for the next 5 years, instead of paying like principal and interest, and you're paying an amortized amount every month, we're just paying interest for the next 5 years, which substantially increases your returns. So this is also a super cool deal, but same concept. We go in, we're going to basically fix up amenities, add a package hub, resurface the pool, resurface the parking lot, add gates, add cameras, just make it sexier, all for the purpose of being able to raise the rents just a little bit, $200 to $300 a unit. And then after 5 years, hopefully sell it for a huge profit. So that's kind of the other side of real estate. So there's two sides. There's residential investing, there's commercial investing. And then inside that, you have passive investing and you have active investing. So kind of just comes down to your preferences, but that's really all I prepared for you guys. And just let me know however I can help you on your real estate investment journeys. So
Awesome. Anybody have any other questions? I thought that was fantastic. Thanks, Mitch. There's just so much to go over, and there's so many avenues that you can do. A lot of us are novice in the real estate world, and I think you hit it right, the nail on the head. Appreciate that. Well, yeah, James.
So with how high prices are right now in the housing market, a lot of times if you're not putting a ton of money down, it can be hard to, not even make a profit, but to break even.
Yep.
So how are you just looking for deals and then using your calculator to see if you can make it work? Or are you okay with not breaking even for a couple of years, or how's that work?
Yeah. So obviously that's kept a lot of people from investing for the last 18 months because that's how it's been for everybody. You haven't been able to actually cash flow anything, and most stuff barely breaks even, right? So, I mean, the Fed has pretty much signaled that interest rates are supposed to come down. So within the next 18 months, we're supposed to see interest rates between a 5 and a 6 again, which would be awesome. Obviously, nobody has a crystal ball, so you just don't know. But the beauty of buying real estate at a time when nobody else wants to buy because stuff doesn't pencil is you can actually get a good price for the asset. So the term I've heard is, it's like something, the price, date the rate. So essentially, like I know a lot of people who they're not worried about it necessarily making money today, but they're banking on in a year or 2 or 3 when interest rates go down, refinancing into a lower rate, and they did get a good price. Likely they're going to see some appreciation over the years that they're waiting. And then once they do refinance, their payment goes down. And then they start to get into the green, if that makes sense. So like, for example, on FHA loans, if you go occupy a fourplex and live in one and you have an FHA loan, you can refinance for free, I think an unlimited amount of times. So in a year, if rates go from a 7, if you had a 7 on your fourplex and in a year they're down to a 6, refinance. And then another 12 months goes by and it's down to 5, refinance again. So you're refinancing down, and your cash flow is increasing. So obviously never buy anything that you can't break even on. But if you have capital to deploy and like there's nothing better that you can do with it and it's just sitting in a bank losing 5% to inflation every year, then the way I see it is go buy. And rates will come down. Make sure that your loan has the ability to refinance. And eventually, when you're able to refinance, it will be making money. That's one.
Mitch, did you say that you could refinance for free on an FHA loan?
That's my understanding. That's what I've heard. So
Really?
yeah, verify that,
And-
Isaac. Don't quote me, but yeah, that's my understanding.
Okay. Cool. Yeah, because I last year I bought like a triplex, and like it was our first rental property, and the interest rate is super high, and we're kind of just breaking even at this point, but just hoping it's going to go up. But if I could refinance at a lower rate, it would be able to cash flow a lot better.
Yeah, exactly. So what rate do you have on it?
We 6.75. We bought it down a little bit.
Okay. So yeah, like watch the rates, man. As soon as keep watching Mortgage News Daily. Go talk to your lender, whoever originated your loan, and just ask them okay, what are the caveats with refinancing? Like how often can I do it? Because I'm assuming you can't just do it every month, as rates are going down. There's probably some stipulations on it. But yeah, ask them what that looks like. And then just tell yourself, okay, when the rates get to 6.2, I'm gonna go refinance this immediately. Or however often you can.
Mitch, another question. So obviously small multifamily, real estate, it's really good, especially if you don't have a lot of capital and you don't have investors. But somebody like me and other people in this call, how can we benefit from the huge multifamily deals? Can we invest, or does it have to be do you have to put a huge amount down?
Yeah, great question. So like that last deal I showed you, the flats. So like, so I am a real estate syndicator. If you hear syndication, that is like me. That's what I do. It's somebody, they're going out, they've put a big commercial deal under contract. And when I say commercial, it doesn't just mean like an office. I'm referring to multifamily as well. And they're raising all the debt and the equity to go capitalize that deal. And then they manage it. And then they return distributions to their investors over time until they ultimately sell the asset and everybody gets their money, hopefully a lot more. A lot of those, so when you go out and do a syndication, you have to do an exemption to issue shares. So you go to the SEC and you say, I'm going to do a 506B or a 506C exemption. So 506C lets me advertise my deal. So that deal I just showed you guys, like it's 506C, which means I can put it on Facebook, I can put it on LinkedIn, I can publicize it for the whole world to see, but only accredited investors can invest in my deal. Are you guys still with me?
Dang. So
Maybe explain what I mean.
Yeah, sorry, I'm still going. I just thought there was some internet issues.
Oh
Can
no,
you
you're
guys-
good. Yeah, we're good.
So only accredited investors can invest in that particular deal, which means you have to have a net worth of $1 million, or you have to have annual income of, I think it's 250 grand, or it's like 300 with your spouse. And if you don't, then like that's that, you can't invest in the deal. And then there's a 506B exemption. For those, the caveat is I, as the syndicator, I can't advertise publicly, but for anybody that I've made a pre-established relationship with and they know me and we've talked about their investment goals, I can take up to 35 non-accredited investors to invest in that deal with me. So that's the difference between 506B and 506C. And we will do 506B deals in the future where you could come park. I mean, typically there's still going to be minimums, probably 50 grand, but maybe we make an exception if it's a smaller deal like the Kentucky one, and we say you can get in for as low as 30 grand. And then that's totally passive. You're investing with us. We're doing all the work, and we're just going to give you a distribution every month or every quarter, as money comes in. And we're going to educate you along the way as well. But yeah, does that answer your question, Isaac?
yeah, that's interesting though, that they make you like be accredited investor. That's crazy. I didn't know that.
Yeah, it's the SEC's way of protecting the American consumer. You know what I mean? They like for deals that can advertise, they want to make sure that you're sophisticated and you're not making like a really stupid investment decision with maybe a shady sponsor. When I say sponsor, that's sponsor, GP, syndicator. That's kind of all the same term. It's whoever's like doing the deal. So that's why they do that. They want to make sure that you have money. You're not making like, if you did lose your money on that deal, and there's always risk on any investment you make, like your life's not going to be over. You're accredited, so you probably have more money, and you're probably a sophisticated investor. And whenever you do these exemptions, you have to go file with the SEC, and that's why they crack down on it. It's ultimately to protect the investors. So, but yeah, it's a barrier to entry for sure. But they might change that. I've been hearing recently that the US or the SEC might roll out like this test that you can take, and they make it pretty tough but if you pass, then it shows that you're sophisticated. And with that, you can kind of get a accredited stamp of approval, even if you don't have the income to truly qualify. So I don't think that's a thing yet, but I've heard that something like that might roll out. But for any of you,
it's going through Congress or something right now. So
yeah, it's going through Congress. So we'll see if it gets passed. But if you guys want to invest into syndications, like you just have to find one that's 506B. And I'll be doing some in the future. So stay tuned. I don't have any right now, unfortunately, but hopefully I will. Any other questions? That was a great question, Isaac.
sweet.
You guys ready to go rule the world?
What's that?
I said, you guys ready to go rule the world?
Yeah, exactly. Exactly. Well, hey, I appreciate it, Mitch. Obviously, there's so much to go over. Appreciate you taking some time, and maybe we'll do this again soon. But anybody that is interested or anything, welcome to reach out to Mitch. He's awesome. So,
Yeah,
all right, guys.
I dropped in, so in the chat, I dropped in a link. So that leads to a newsletter. It's like my CRM, client relationship management system. But there I'll be posting education, or I'll be talking about deals. And if you're in that CRM and you're unaccredited, you know, we'll build a relationship over time. And that way, when I do have 506B offerings, I'll blast them out, and whoever's tagged as having a relationship with me, like they'll be able to get that email legally to see that deal. So like go join my newsletter with that link. And then I'll also drop in my card that has my email and everything. So if you guys want to call me, or you need a real estate agent, I can represent you on anything, at least in Utah. If you want to buy outside of Utah, I can help you find somebody local to represent you. But yeah, just let me know however I can help. Here's the link to my card.
All right. Hey, awesome, Mitch. Appreciate it. Thanks again.
Yeah, thanks, fellas.
Out, guys.
Thanks, Mitch.
Later.
Hey, thanks, Mitch. You're awesome.
Thanks, Carr. We'll see you.
Bye.
Thanks, Mitch.
Yep, see ya.